In this video, I want to talk a little bit about the FAANG. We're going to follow up on those charts, as those are the ones that we generally like to trade and keep our eyes on, the most popular markets or most popular stocks in the market. And so let's start off with and go down through the list. We're not going to cover all of them. I just kind of want to show them all in here. I'll talk about a couple of things that have happened. I've had some people ask questions about Tesla and why I don't talk a little bit more about Tesla. So we're going to talk a little bit about Tesla today, and we'll talk a little bit about Apple here. I want to talk about Apple and Tesla, and then I want to talk about some of these other markets that have been added to and removed from the S&P 500. So let's come in here, and first thing we're going to do is look at Apple. Apple's finally making a little bit of a pullback in here. Everybody wants to get into Apple. It's like, when do you get into Apple? Apple's always making new highs, and so it's difficult to get in. The idea is that you want to be taking long positions whenever the market is above your blue lights, and short positions whenever it's below the blue light. So in Apple, we don't generally want to take short positions, unless the coronavirus is coming and you're looking to short the market. But nonetheless, you want to take these long positions whenever it's above the blue lights. So the cross over the blue lights is the entry point initially, and you can see, very beautiful entry points. And as I've always pointed out, the Bulls and Bears doesn't give very many entry signals on nice trending stocks. So if you get one, you should definitely take it. And as you go through and we look through some of these different charts, you'll notice that they're very highly effective positions to be getting into the market. There's also the blue lights, so we have to take those into consideration because the market does pull back. And then when it breaks above the blue lights, those are entry points once again. So these are re-entry points into the market. And so you can see those are corresponding with the arrows as well. So those are always good entry points along the trend as the market moves forward. Now we're coming up into here, and the market's starting to be very overextended up in here. You can see the stochastics has been riding way up high, and our momentum is starting to drift lower. And so the market's starting to come down. You can see the last two bars on the volume are red bars, so the market's starting to fall. It closed the last 2 days. It's down right now today. If we come down here and bring it down to the 15-minute chart and take a look, you can see that today it gapped up and then it just blew off. It sold off all the way down, filled the gap, and it's back down to basically yesterday's close price. So are we going to be jumping into Apple right now? You never know. This dumb stock can go. It's like if you say Apple's going to go down, you get terrorized by all of the Apple lovers. So the thing is this market just seems to always go up. But let's do some technical analysis on it anyway and figure out where this thing might go technically speaking. So first of all, is we have our nice little ABC pattern in here. And then we have the rally all the way up there. You can see that it went up, created this beautiful topping formation up in here. And now, technically speaking, it should come back down. Where's it going to come back down to? Well, if we do our Fibonacci butterfly in here, we've got a horizontal line right here. And technically speaking, that's where we would kind of expect this market to come back down to. It's gone way beyond the extension. So if we bring this down to 100%, this was where we were anticipating the initial move in the market. It made this first drive and looking for the retracement back to here, and then a rally once again. It broke through that and it took right off. So technically we could come in here and once again we could reset all this and say, well, here's our new ABC pattern. Okay, on Apple that might be true. Let's blow this up a little bit and we might get a little rally, a pullback, another big rally up in here. That would mean that our bow tie line would be put right in here at this peak where the A's at. And that would bring us in here, and you can see that the pullback on that, again, if that was our pullback, our ABC pattern in our extension, we went way beyond the extension of just this small move in here. The extension would bring us back to this level here. So we're way above that. So the question is, do you think that Apple's going to come all the way back down and touch and test this yellow line? Nobody knows, but that's our kind of our little test zone when you're talking about a little Elliott wave in here. This would be a little micro Elliott wave. So you got X, 1, 2, 3 in there, and this would be drive 1, drive 2 from this new reset of a small wave. So we could come in here and say this is our zone. If it breaks below this point here, this is our Elliott wave zone. If it breaks below the B point, then we're no longer in an uptrend, right? We've changed over. So we would look for it to come down into this region here. Generally, it's at 100% right now. Technically, that's kind of where we usually take a new long position and then look for the next leg up. It would be nice to see this thing come down a little bit further than this, but it's Apple, so nobody knows where this thing can go. It can go to the moon. and everybody just keeps jumping on and piling on as this market keeps going higher. So I don't think we're going to see it way down into this region here. So how could we take advantage of this? First of all, you might be scared to take a long position here because it is so overextended, and it does really need to have a blow off and a pullback in a profit-taking mode before we look to take another long position on Apple. So the other strategy would be that you could take a, you could go in here with a married put. So you could buy 100 shares and then buy a put or a couple of puts in here at the money to protect yourself to the downside in case the market does continue down. But you would also capture the long side of this market with some shares if you want to do a married put. Now, the other strategy would be to come in here and look at some options and coming down, and we're going to go out to this 24-day options once again. This is the one that seems to have most of the high volume and open interest in it. And as you can see, we'd come down here. We put on what I call a chicken wing, which is just one leg or one wing of an iron condor. So we want to come down here, and we're going to look out into the probabilities of being out of the money. We'll start right here at around 90. We'll just go ahead and we'll put a sell in on that one, and then we'll put the insurance policy right on the other side. And you can see that we get a position way down here. Notice where it's at, technically speaking. It's way below the Fibonacci zone, and you would get, with a $500 investment, you would get a return on your risk of about 8% or $42. So $42 for every $500 you invested, which would be an 8.4% return on your money in 24 days. Now, again, if you annualize that, that's going to be about an 84%, 90% interest rate annualized. So that's a pretty good return, but we can get better, technically speaking, because we don't need to be that far away from the market. So we could bring it in a little bit closer. So if we brought it in just to the bottom of the Elliott Wave zone right in there, you can see that we'd get an 11% interest return on our risk in 24 days. So that'd be $57 for every $500 invested. And you'd be still clear down here below this level here, and the name of the game at this point would be that the market needs to stay above your red line. So that means Apple should not collapse and come all the way down here and break this point. That's what this market would have to do for you to lose your $500 or to start losing your money. Now, you might have a little drawdown into your margin, but this is what would have to happen for you to lose any money. You'd still make your $57 on your $500 investment if the market just landed above that red line, hit that purple line before it hit the red line. So that's the game you're playing in there, and you can see down here the probability of that happening is 87%. So you've got a pretty good probability. There's only a 12% chance you're going to lose your money on that one. If you're pretty bullish on Apple and you think Apple's doing well, they've announced their iPhone 12, and I think that's part of the fundamentals of this market and why it's running so hard. Everybody kind of skipped over the iPhone 11, and the iPhone 12 has been a big weight. Everybody wants the iPhone 12, and so they're thinking that that's going to be a big sell for them. So nonetheless, that's kind of where we're at with Apple. If we look at this just from a Fibonacci zone, from the low of this point here to the high, the retracement on this would bring it back to 50%, would be right there where our red line's at. So there's that to consider, and that's a little bit of money you can take in there without having to take a long position in the market because you're worried that the market might not continue higher, might drift in here for a little while. And if you think it's just going to drift around in here for a little while, this would be a good way to pick up 11% interest on your money. 500 margin would get you a $57 return. So that's one strategy with Apple. So let's come over, and the reason I wanted to go into a little bit more detail here on Apple with this one is because if we come down to Tesla, it's a very similar strategy. I mean, we're going to see almost the same thing. The pattern's almost exactly the same, and so we could just repeat this exact same thing over here with Tesla. So if we come in here, we go down to the 24-day options on Tesla. We're going to slide down, and again, we're going to look for an opportunity to put on some far out of the money options, and we're still in the same situation. If we think this market's going to go higher at the top of this Fibonacci or stochastics level, then we would probably want to use a married put and protect ourselves to the downside in case this thing falls. Doesn't mean we don't think the market can't continue higher. It certainly can, but it is at a zone right now. If we take A, B, C off of this high and this low, you can see it came up and it touched that 100% level right on the number. And now it's starting to pull back. Does it mean it can't pull back and come all the way back down and test some of these low numbers? No, it certainly can. Does it mean it can't just make a little bit of a micro pullback and start to rally up and hit that 130.9, which is another one of our Fibonacci golden ratios, and 161.8, of course, those are up there as well. But from this A, B, C pattern here, this is where we're sitting. So what could we do? Again, you know, if you don't want to take a long position, you're a little bit nervous about that, but you think Tesla's a good opportunity, and you don't think it's going to fall and collapse down and come down into this region here, you could come down, do the same thing. We could put on a chicken wing. And I call them chicken wings because we're not putting on the upper side. We're chicken. We're scared to put on the upper side of this iron condor. We only put on the one leg or the one wing. So it's a chicken wing. It's not an iron condor. So we come down here. And we're gonna come down to probabilities of out of the money. Let's come all the way down to 90 and just see where we're at. We're gonna come in here. There's some options with some volume open interest right there at 89.21. Let's go ahead and sell that one, and we'll buy this one and see how we fare. Okay, so you can see where we're at on the market here. That's a 10% return on your risk, $1,000 investment, $105 in 24 days, or 10%. So let's cancel that for a second and come in here and draw our Fibonacci bow tie. So we come across, this is our peak point of B. This is where we'd expect the market to come back down to and touch somewhere in this region before it starts to rally once again. And then if it breaks below this point here, this is where we have the bottom of the Elliott Wave. So drive 1, pull back, drive 2. And of course, we've got the drive 3 in here, drive 1, drive 2, drive 3, and we're actually on drive 4 of the Elliott Wave. But doesn't mean it can't go higher. It certainly can. That's just traditionally speaking. So if we start this over and say that this was the big break right here, we'd have drive 1, drive 2. We'd get a pullback and look for drive 3 once again. Where would it come back to? Well, right around this B point in here. This would be kind of the buying level. So we would look for the bulls and bears to flip over, the possibility of something like that happening and giving us another arrow and another crossover, which are pretty rare, but they can, you know, they can come along. If we can come back and take a look, here's a crossover. Here's the arrow again. You know, you get so few of them. There's a buy arrow right there, and then you get the crossover, the blue lights right here, and those are your optimal locations. Now remember, as long as the market is above the blue lights, if you get a pullback and you're no longer making higher highs and on the trends, higher highs and higher highs and higher highs, and you finally get a break and a micro pullback and get a lower high, and then it breaks above the previous high right in there, that's another great location. Now this is kind of a small little micro pullback that we got right in here, but because it's above the blue lights, we're rallying, we're broke to the uptrend, you get a micro pullback right in here, so you're not going higher, 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 higher. Now that's the micro pullback right there on a break above that bar would be another entry point. You could get in right there, and you can see that that's another entry point right here. Now we're getting extended. We have to count the bars 1, 2, 3, 4, 5, 6. We had six big extension bars. 1, 2, 3, 4 big extension bars. If we count some of these other smaller extension bars, you know, we're getting up in there where we have the quantity of extension bars. I like to go for 6. 1, 2, 3, 4, 5, 6. And you don't count the little tiny ones in there, but the bigger ones, 1, 2, 3, 4, 5, 6. And so we got 6 on this rally up, and we got 1, 2, 3, 4, 5, 6 on this rally up. So we're kind of peaking out up in here. It hits 100, and that's kind of where we're at when it starts making these big runs. So basically the same thing we've got going with Apple. You could come in here, you could price out some of these options, and you could put your positions in here. So let's come down and just real quick, we'll go sell one here, and we'll buy one here. And you can see we're down midpoint of the zone, below the B point and above the C point. So we're kind of in that zone. If it breaks below this one, we're no longer in an uptrend. We're still in an uptrend as long as here. We want to come in and look for a buy opportunity, go long. But this is just selling some. You can see once again $1,000, $100, 10% at that point right there. All right, let's go on and let's take a look at some of these other markets. NVIDIA is another one that's been moving quite strong. I'm looking for this one to kind of give us a rebound. I call this the FAANG markets and then the FAANG Plus. And NVIDIA is not one of the FAANG, but it's one of the FAANG Plus. And you can see this has just been a crazy market. NVIDIA, once again, might not want to be a buyer at the top right up in here. Look for a retracement. You can see and anticipate that the market's going to cross over these blue lights here eventually and give us a little bit of a pullback, and maybe that would be an opportunity to take a long position and a rally once again. So in the meantime, you could put on a chicken leg down in here and pick up a little premium by selling some premium in NVIDIA. NVIDIA's got a pretty deep options window. And so again, we're going to come down to that 24-day option and find out where everybody's hanging out down here. We'll sell one here, buy one here just real quick. And of course, you want to do a little bit more due diligence, move these around, see where you're going to find the optimal location, the optimal interest rate versus where the support and resistance levels are. Make sure you're not putting it too close to the market, but you know, it's kind of You have to search and find. It's like a diamond in the rough. You're going to find the ones that have the high volume, the high open interest, also have a high probability of being right, also behind the area of support that you're worried about the market coming down and testing, and also you want to make sure that you're making a good enough interest rate on here to make it worthwhile. The margin requirement is $500. You're going to make $58 for every $500 you put in there, which is about 11% return on your risk in 24 days. So you have to decide if that's up, what the technicals look like and whether you decide you want to do that or not, and take the risk and put that on. So let's come in here. That's NVIDIA. We've got Netflix. I like Netflix for a long position in here. Now, the problem is we've got 3 rallies in here. So the market started to rally. We got the blue lights crossing in here. And we got the break right here. And now the market's starting to pull back a little bit. We've got 2 down arrows right here indicating that the market's more bearish than it is bullish. But if we go for the longer term trend, this whole thing, we're down here testing this previous low. So it's nice to be able to buy when it bounces off this support level. So we got to buy here, you got buy here, buy here, buy in here. But look at where the arrows were coming in on the bulls and bears. We finally got a buy signal right in here. A big rally, pull back, and it's pulling back and it's bouncing off this area right in here. We're kind of getting a little wedge formation or triangle in here, but we did break above the blue lights here. I'm kind of working through this one, trying to decide whether I want to pick up a long position or not. I want to see if it's going to bounce off of this area of support and then pick up a call option and then maybe put on a chicken wing down here to help pay for the call option that we're looking to go long. You can see once again the options are pretty deep on this market, so we can come back out here quite a ways, and we would want to be below this area of support. Because we don't think the market would come down and break below that before it would start to rally once again. It might. Nothing's ever guaranteed, but we want to come down here, go back over to our options. We like the 24 days. We're going to come down here to about the 90s, and that's where we want to start. We can go up as high as the 80s, but we like to start at the 90s, so we're going to sell that one and buy this one. And you see how far away we are from the market. It's giving us 7%. I think we can do better. We want to stay below that area of support. If it breaks below that area of support, I'd be nervous that we could come down and test this next area of support. So that's kind of where we'd want to be if we thought there was 2 levels of breaking here on the support to the downside on Netflix. But if we're bullish Netflix and we think we're just going to bounce off this area of support or this trend line and start to rally once again, then we could come in here and be a little bit more aggressive with this, and we could bring it up to maybe the 80 level. We bring it up there, and if you put it up there and it's still underneath this level of support right here and you think we're going to bounce and rally, that would get you 17.6% in 24 days. Now think about that. If that was annualized, that's 175% or better annualized return on your money. So you're going to get $88 for every $500 you invest in there. You're going to put up in there, so that's your return on risk, 17%. So if that market broke below there, you'd probably want to cut your losses and get out of that thing. But it's just got to close. It's got to hit that purple line before it hits the red line. That's really the game you're playing. And if that happens, if it stays above there, then you're going to collect your 17% interest on your $500 investment, or $88 in this case. If you think that's a good bet, then you come in here and you could raise that up and you could put a couple thousand in there, 10,000 or whatever you want to put. And then that's how you increase your quantity. So you put the margin requirements to be a $5,000 investment, you get $820 return, which would be a return on your risk of 16%. And so that's kind of how you'd play this one if you think that Netflix is going to stay above our areas of support. Here we got the area of support on the horizontal line as well as on the trend line. So that's just a quick look at Netflix. We've got Honeywell. Now, the reason Honeywell is in here is because Honeywell was just added into the S&P. There were several markets that were taken out, and Honeywell was one that was added in. So Honeywell is one of the new S&P 500 markets that's just been added in, and you can see that's why this market jumped. And it kind of rallied up hard and then pulled back today. It didn't break up, and it's not closing at the high of the market. If we come into the 15-minute chart, you can see a little bit better how this thing gapped up on the news that it was being added into the S&P 500, rallied, and then it's kind of pulled back to kind of, not down to where it was at, didn't fill the gap, but this is kind of where we're sitting right now. I'm bullish on Honeywell. I think that that's good news for Honeywell, and now that it's inside the S&P 500, a lot of big firms, a lot of big investment firms, just pump money into the S&P 500. A lot of retail traders trade the S&P 500. Problem we have with Honeywell is that there's not a real deep options chain on it. So if we come in here and take a look, you're kind of restricted to what you can do as far as finding something that's real big. But there's a little bit of players in. There's a few players in here, and so we can come in and we can price some of these out. If we come into 90%, we can come in here, we can sell this one, but you can see there's no volume, no interest, so we have to go up to the next one up. And if we wanted to buy this one here, if we had a small quantity, and I've already done this myself, I'm in this market exactly right where this is at with my real money account. So I've already done this one. I took this position and took a long position with Honeywell. I believe that was good news fundamentally for Honeywell to be added to the S&P, and I don't think it's going to crash and come falling back down. So we can be a little bit more aggressive with our numbers, and we can come up and put on one of these chicken wings in here. And I think that's where I'm at right there, about 11%. So a $250 investment, you're going to get $29 in the next 24 days, or 11% return on your money. And you can come in here, and I think we did 10 of these, if I remember correctly. 7, 8, 9, 10. $2,500. I might not have done that. I might have done 5 of them. I think I did $1,000 in here. I think for me personally, on my self-directed IRA account, I put 5 of those in there. So about return on risk is about 12%. So you put in $1,250. If it stays above that red line, hits that purple line before it hits the red line, which just means it's going to stay bullish, we're going to collect our 12.8% interest in the next 24 days. Of course, if that was annualized, it'd be upwards of 130% interest on your money over an annualized time period. So that's pretty good return on your money, $160 on a $1,250 investment, as long as Honeywell, that's just been added into the S&P, stays above that red line. So if you want to, you can also pick up a call option and continue to ride this thing up as well. So that's the ones I wanted to talk to you about in particular. Facebook. We picked up Facebook, if you remember, on a break above this market, and it's doing quite well for us. We got a chicken wing on here. In my real money account, I got a chicken wing and also a long position. So we're doing well with that one. It just broke above the previous high. So we're happy with that one. Disney is another one that we're looking at. Now, Disney is one that you want to kind of look at the blue lights and see where this has come. See, this is kind of a break above the blue lights. We got the arrow. Unfortunately, because it gapped up over the blue lights, you'd have had to get in on the open of this market here to take advantage of it. And that's not moved too far on Disney, but you can see down here, these were some nice moves in here. Every one of these crossovers of the blue light were pretty darn good places to be getting into Disney, as you can see, and the arrows as well. So we're looking for this market to actually break back down, break below. Disney's had a little struggle because they've had to, where does Disney make their money? They make their money on theme parks, and they make their money on movies. And both of, they're an entertainment industry, and they've struggled with that because not a lot of entertainment going on. They've had to postpone a couple of movies releases, and and their theme parks are not exactly up and running at full speed either. So they've been struggling a little bit, but they've been coming back, slowly but surely. They've been drifting back up with the rest of the market. One of the things that's kind of helping them out is they have a competing product to Netflix, and it's been doing quite well, and people have been subscribing to that, so that's been keeping them alive as well. So, what's going to happen here? Are we going to get a break above the previous high right here and look for this market to continue higher? Or are we going to break the blue lights and get a bit of a pullback like we've had in the past? So that's kind of something that we can look at here in Disney, and if it does come back, this would be kind of our first point of return right back in here, testing this level. And then if it broke below the next level down, this would be our Fibonacci bow tie, right? So this would be our level that would be that, Disney's no longer in an uptrend. If it broke below this one, Disney would now be in a downtrend. So do you want to put a chicken wing in here? You could come way down here, come out to a 90%er, and let's just see for fun. Well, they're going to have to be pretty close. I don't think, let's see, sell. Yeah, look at that work. We're going to have to go clear up there. Oh, this is 3 days. Let's hit cancel on that. Come in here. We're going to come down to the 24-day. Just for fun, we'll drop one of these in here. I don't want to waste your time. Try to move as quickly as I can. Yeah, you can see there's people putting chicken wings in here. Let's go to the upper side. Oh, they're putting iron condors on here too. Look at this. We've got some. It looks like to me that's when they're even distance from the top to the bottom of the at the money. Those are iron condor wings. And then here's an outer condor wing, and here's another outer condor wing. There are a lot of iron condors here on Disney. They're anticipating that this market's just going to continue to drift sideways. If you think it's got a little bit of a bullish uptrend to it, you don't want to take the risk of being on the upside, just take the downside. That's okay too. Take the chicken wing. Good to come in here and sell this one. A lot of people are putting gaps in there. So that would be a 6% interest, $500 investment, 6%, $32. down in this region here. If we bring this all the way back up and reduce that margin, you can see that we increase. We make less money, $9, but we get a return on our investment of 9%. So for every $100 you put in, you're going to get $9 back. See, that's we go from 6.4, where it looks like most everybody else is doing that, and we can bring that up there. If we get those filled, go all the way to a 9% interest. That's much better. And so then we can just increase our quantity up to where we want that. If we bring it up to 5, there's a $500 investment, $45, 9% return, and you can decide if you want to do that one. Now, this is how I do it. I go through and I look through all these charts. I drive down through these volumes and open interest. I look for the probabilities of being in the money. I do the Fibonacci bow tie. I see where we're at on the support and resistance, whether I think this market's going to go up. Look at the fundamentals, trying to decide if the market's going to be bullish or bearish, if there's something good coming, any news reports or any earnings or anything like that. And then I price these things out, look at the interest rates, and see if I can't get a good opportunity to make a little bit of money in here and put some of these on. If I like the opportunity for the long position, I'll put on a chicken wing down here, and I'll come in here and buy a call option, pick up a call option, and look for this market to continue higher and have the chicken wing help pay for the cost of the call option. Now, that's actually called a synthetic long. It's kind of a ski-wampus synthetic long, but I like to give these things my own names, so it makes it easier for me. This is my little chicken wing down here, and then a long call would help pay for it. All right, guys, so that's just a quick look at Disney. There's one more in here I wanted to mention, just because it was added into the S&P today. So this is Amgen, and I like this one. I picked up a call option, and I put a chicken wing on this one because I'm bullish on Amgen, just because it was added into the E-mini S&P or into the S&P 500. Some of the others were moved out. ExxonMobil was one of them, and this one was added in to take its place. And so when that happens, you get a little bit of a shakeup, and I'm looking for this market to continue to rally, and I put a synthetic long on here, so a chicken wing with a long call, and looking for this market to continue higher. Let that chicken wing help pay for the cost of the call option. All right, guys, I'll let you do the math on this one. Put your support and resistance areas on there, and this is a fundamental play for the long position on Amgen. And that's just a quick run-through of primarily the FAANG stocks, which this is the FNGU. You can't put options on this one, but if you're trading with shares, this would be a great one to follow. But that's FNGU, FAANG, and some of the FAANG Plus stocks.